investing out of our second fund, have $174 million under management, and are focused on backing women and people of color.
My name is Kevin David, and if you want real financial freedom for yourselves and for your loved ones today, then the time is now. And I will be there to help you every step of the way. What is up, guys, and welcome back to another exciting episode of your favorite or soon-to-be favorite podcast, The Kevin David Experience. Today we have a very special guest. Before we get into that, I wanted to give a big thank you to all of you guys who are leaving reviews on iTunes, and also you guys who are checking out the podcast on YouTube, because we are now posting it on YouTube as well. So let me give a big warm welcome to Jarrid Tingle. So the first question that we ask everybody, Jarrid, is to describe your entrepreneurial journey all the way up until right now in 60 seconds or less.
All right. So I was working in private equity with my friend and now co-founder. Started angel investing for fun. Just looking for some VC-backed companies to potentially invest in. Fast forward, we found a market opportunity backing women and people of color. So we did that for about 2.5 years, did 6 angel deals, building connections, building our sourcing pipeline, building our investment thesis. Went to business school. From there, we were roommates, just like working on this while, getting our MBA. Got some great backers and got a lot of press coverage, and basically showed us that, we could potentially get into business. So a lot simpler. I'm saying a lot simpler than it actually was, but I think the biggest thing was like being in the right place, right time, having a couple people that believed in us early, and just being able to iterate. So now Harlem Capital, we're investing out of our second fund, have $174 million under management, and are focused on backing women and people of color.
I love that. That's awesome. So do you think luck exists? Because you said you're in the right place at the right time, but I don't think that exists.
Well, I think you need skill and you need opportunity, and hopefully those two things line up, or you can kind of make it work until that happens. So I do believe luck exists, though, because there's people that try to do exactly what we're doing, but we're just too early, or the opportunities were in the right place. But for us, we came out before all the conversation around George Floyd. So when that happened, we were well positioned to kind of capitalize on that from a fundraising perspective. But even then, we were able to have somewhat of a first mover advantage. I think people were really excited about what we were doing and how we were doing it before it became too mainstream.
Yeah, and it's interesting too, because I'm not huge into the investing world, but I hear things through the grapevine and on Instagram and things like that, about like Nas, the rapper, for people who don't necessarily listen to rap or hip hop, making tens of millions of dollars from investments in like Coinbase and things like that. And then you also hear about Kevin Durant and other kind of like celebrity, athletes and things like that getting involved in investing. Like, what are your thoughts on that? And, for people, wanting to get involved in investing, like, how do they actually do it?
Sure. I don't know either of them personally. It seems like Nas' portfolio has done really well. Anybody with Coinbase in a portfolio who got in early is going to be doing just fine. I think Andreessen's returned all their funds with that one.
Yeah.
But yeah, Matt, I think generally what we're seeing is people who have had success in one realm, whether it be entertainment or whatever, they want to get involved into startups and entrepreneurship. I think is fantastic. I think in general the broader public wants to get access to these investments that they haven't had access to before. So whether it's people getting stocks on Robinhood, or people wanting to angel invest in portfolio companies of other VC firms, or folks that want to just get after it, I think you are seeing a democratization and a push for just more access to a broader community. So right. I'm supportive. I think more people around the table makes things better and gives opportunity for more entrepreneurs.
So if somebody wants to get involved in angel investing, right, can you talk about like what your investment thesis either was when you started or what it's now evolved to and why?
Mm-hmm. So to get started, you really just have to start meeting people. Fortunately, in this age, it's really easy to do so online, Twitter, LinkedIn. You can listen to podcasts, etc., and just start talking to connections, getting on Zoom, and try to ask for who has companies. So angel investing is actually not that hard to get into. Doing it well is very tough. It's hard to make money. So I would focus on your particular skill sets. If you work in an industry or at a company that has alignment with what would be helpful for an early stage company, you can leverage that into finding deals where they can use your expertise. If you're just if you don't bring anything to the table and you're trying to find opportunities, there's going to be a little bit of adverse selection to that. So that's how we approached it. We learned a lot, made some mistakes. But now we're in a position where we have a big enough network and are able to add value, so we find great opportunities.
And as far as like the actual companies that you chose, like let's say that, you know, somebody's hustling, they're talking to people on Twitter, they're finding companies and they're trying to make the decision ultimately whether or not to invest. Like what were you looking at? What's important to you when you're choosing whether or not, like how to allocate your money and your investments?
Yep. Typically VCs focus on three key things: team, market, product. One, a strong team who has a fit with what they're trying to do, hopefully relevant experience. Two, market, a big opportunity that means you could grow a business into a large company in this category, or create a market, which is a little bit, a lot less easy to do. And then third is just like having a good business. So something that makes sense, that's differentiated from the competition. So those ultimately are what all the firms do, all individual investors do. But like the weighting and what it actually means to you, because it's subjective, is what changes. And so I think finding your core and also just having a group of people that you share opportunities with is probably good, because you may have your own ideas, but once you start talking to people, sharing ideas, sometimes you can make better decisions.
Right. Yeah, I like that.
You don't know what you don't know sometimes, and you need a lot of volume, right? You need a lot of shots on goal. You need to see a lot before you can be selective and shoot some opportunities.
And what do you think about, you know, people who go like all in? Because like you hear about people who go like all in on the right investment and they make like just a freaking fortune, right? But like 99.9% of the time, I would argue at least, it's better to take more shots on goal with smaller amounts, right? So for like, you know, people who are listening to this who might have like 10, 20, 30, 50, maybe even $100,000, like how would you approach, you know, investing, you know, with kind of the highest likelihood of success?
Yeah, I mean, the best thing people can do, like financially, is probably max out their 401ks, invest in the S&P 500. Any money you angel invest, you should be able to afford to lose. But assuming you're going to angel invest, it is good to have a portfolio. So I would recommend, you know, whatever you see, maybe max invest in 5% of those. That ensures that you're at least doing some diligence. I would have a budget for it and then not exceed it. In terms of like trying to pick and choose and sometimes double down, you know, if you're on the inside track, let's say you're working at, you know, Stripe or Uber, and you're seeing folks that are seeking you out and you know that they're going to be successful, maybe you double up. But if you're an average person, I think picking a number, 5K per investment, you know, 10K per investment, and just sticking to that, doing a couple a year, is probably good until you have enough experience to feel more conviction to put more in.
So for people who run like funds or you know, because like a fund to most people is like this like magical thing, but like, you know, at the end of the day, it's like a business and it has to operate. You know what I mean? Like how are most funds like set up? How do the partners of the fund actually like get paid? Like what's the normal structure for like a layman who doesn't do that day to day? Yep.
So a fund, we invest money on behalf of investors. Investors can be individuals, they can be institutions. More likely they're going to be institutions if you have a scalable fund. Investors get compensated in two ways. One is through a management fee. On average, investors of funds get 2% annually of the total amount of money that they're managing. And they also get 20% profit sharing. If you generate a profitable return, you get 20% of that. There's a little more nuances, but that's generally how it works. There's nothing really magical about it, but I guess what it means is like, because we're investing other people's money, it means we have accountability, but it also means that our downside is protected a little bit because we can have salaries and everything. And we're able to be a little more patient, right? Like we're not investing money that we need back in a year. We can really take the whole 7 to 10 years to harvest and maximize returns and value.
Right. So you went to Harvard, right? What would you say to people who say that college is a waste of time?
We're in an interesting era. College is not a waste of time. And for a lot of people, particularly underrepresented folks who don't come from a lot of money and don't have family members that can get them jobs, right? It is a huge tool. I do think things will get, I guess, decentralized or debundled, right? Right now you have the academic component, you have the social component, you have the career component, right? All these things I think can be split up. But I think if you want to pursue business, going to a top 20 school is generally a great idea. If you have a specialized interest in like engineering, then it matters a little bit less where you go as long as the school is good in that program. But I think everybody has to do their own assessment. When you start adding in student debt, then the risk and return profile becomes different. And so I think you have to look at the factors. But again, for people that are trying to climb a social ladder, it probably is helpful to go to college, assuming that you have the right major and are going to the right place for what you want to do.
Yeah, and it's an interesting argument, right? Because like to play devil's advocate, I would probably argue that I wish I probably didn't go to college.
Yeah.
Only because like you hear about all these like 19-year-old kids that are like making millions of dollars from, their e-com business or online or whatever. And like, it's very kind of like out there for some people, but it's very real. Like I know people that have done that. I know 19-year-olds, right? But the thing is as well, like, and to give like a metaphor, right? Like why do personal trainers exist, right? Nobody needs a personal trainer, right?
Yeah.
But people use personal trainers because it helps them be accountable and actually like go to the gym and get in shape, right?
Yeah.
And so I think like the reason that college could potentially be useful is a lot of people don't have that like self-motivation to like go and figure out everything online through YouTube and blogs and implement it. You know what I mean?
Exactly. Plus, I mean, you may meet great friends, you may get your first opportunity, but yeah, if you know you're good at marketing or you know how to use these platforms or you're great at trading crypto, there's plenty of ways to be successful. But for the average median person, it generally is good to get that first leg up and then decide, once you get early career, how you're going to go about it. But no, there's many ways to win, so I'm not going to tell any one person what to do, but I think on average, it's probably solid advice still to go.
So why did you choose to because there's kind of like two routes, or I mean, I'm sure there's more than two, but let's say for the sake of argument, there's two routes. You either build the business or you invest in the business other people build. Like, why did you choose the kind of like investment and fund route versus like actually being the startup founder yourself?
That's interesting. I never really considered being an entrepreneur for an operating company. I don't come from money. It would have been a huge risk. I did not have the risk tolerance nor an idea that I wanted to run with. It's the idea, but also execution. Investing is more of an apprentice model, right? And so I worked in private equity under some folks. Then I angel invested, and we got to kind of be each other's apprentices, right? And we felt comfortable in stages where there really wasn't as much downside, right? Worst case scenario, we get a salary for a couple years. If it doesn't work, do something else.
Right.
So I think it just depends on your personality and your skill set. But I think what pulled me into Harlem Capital versus just working a job was like we saw an opportunity, and that opportunity was to back founders, people of color and women that haven't traditionally got a lot of capital. And so really that pulled me in more than anything else. Otherwise, I'll be working for another investment firm just as an employee.
Yeah, and it's an interesting idea too, because working like an entrepreneurial job, like because nowadays, and I read a lot of like business entrepreneurship kind of autobiographies and things like that. Keith Raboy, who is like one of the co-founders of PayPal, he talks about how now is actually the least risky time in history to build a business, right? Because like there's no hard costs for the most part, right? Like AWS scales as you go. It's basically free when you have no traffic, right? Unless you're building like a hardware company or something like that, like you can really bootstrap things, from the beginning. A question that I was interested in, because I didn't go to Harvard, I wasn't smart enough to go to Harvard, or whatever argument you want to make about that. For people who are listening and saying, well, Jarrid went to Harvard, but I can't afford Harvard. Right? What would you say to people who say that? Right? Because I was personally in kind of a unique situation where my parents made too much and also like not too little, to the point where they couldn't afford it, but I didn't qualify for the scholarships because they made just enough, right? Like for people who are listening to that, like how, they say, oh, well, Jarrid could do it because he got like lucky or he had this or that. What would you say to them?
Yeah, there's a lot of people in that bucket, and those are the ones that really have to think hard about if they're going to take debt and go. There's more information out there now than there's ever been. So I think between Twitter, LinkedIn, podcasts, like if you're just trying to seek knowledge or build a business, it is the best time ever. There's more capital than there's ever been, right? And so it really just depends on your risk tolerance. I think if you're having a good idea and something's calling you, I say go for it. If you still need some time to figure it out, then you may want to do something else more safe, whether that's going to school or working for somebody else. But yeah, it just depends on your conviction. And I do think if you have a support system financially as well as emotionally, then you're able to weather some of those entrepreneurial challenges. I mean, you did it, you're successful, but I'm sure there were very hard times where if you didn't have the support, it may have been tougher.
Yeah. Yeah, so let's talk about actually like stages of investing, right? Because
Sure.
for people who are interested in this, right, for somebody who may not have as much experience than you have, can you talk about like seed, A, B, C, what those things all mean, and then like the thesis by which you guys invest and why?
Sure. So I'll start with the second question. So we focus on investing in people of color and women, mainly because we have a very diverse network that overlaps with this community, but we also see the most opportunity where they're not getting funded. There's arbitrage and alpha if we're able to do this right. And we can also be a first mover, thought leader, and help create the market to become more successful and kind of leverage that. In terms of stages, what they mean, honestly, the nomenclature at one time was very clear. Now it's all blurring. Generally, seed stage means that you have an idea, you probably have some customers, or at least you have a product that's built, and you're ready for institutional capital. Pre-seed is anything before that, maybe when you're just an idea or just a team. And then usually the letters come after seed. So after your seed, then you raise your Series A, Series B. The philosophy is that you go through time, you unlock certainty in the business, you make traction, and then investors give you another tranche of capital. That way, no one's putting in, $500 million that they're going to lose before you even do anything, right? They're kind of staging to match the risk.
Yeah.
That said, it's all changing. There's bands of where the averages. I mean, the average seed deal right now is probably between $2 to $6 million round, maybe a $15 to $25 million valuation. But after that, it really just depends on the type of funds and the amount of money you're trying to raise.
Right. And what do you guys focus on, like pre-seed, seed, Series A, or do you just go all across the board?
We're focused on seed, but our barometer is $2 to $5 million rounds, sub $30 million valuations where we play personally.
Got it. And so when you're giving that amount of money, do you always get the same percentage of the company? Like for people who don't do this, like how does that work?
Yeah, so certain firms are ownership focused, like we are. We look to get 8 to 12%, hopefully more like 10 to 15% in a company for that check size. That implies valuations, but it does depend on really the biggest thing now. It used to be traction. Now it's more about supply and demand. If you're a hot founder and you have a lot of VCs, they're going to bid up the price and get less ownership. Some funds don't care about ownership. They just want to back founders, and they may have target check sizes, but it just all depends. And so there's no cut and dry way. I think for every firm's going to have a different way of look at it, but most firms are looking for a particular ownership target similar to ours, like 10%.
And that's interesting too, because like seed means that they haven't made any money. Like there's no metrics. Like you're not basing the valuation on anything other than just gambling, right?
No. Sometimes there are metrics. Like it's all about hypothesis testing. Like if you were at a company that's doing something similar, you spun out on your own, that's a little bit de-risked because you know the market well. Maybe you have an idea, maybe you have some test customers, maybe you have a product, right? There's not nothing. I think usually there is something, and the only times you can raise money when there's nothing is if people just really believe in you and the vision.
And the way that people believe in you and the vision usually is that you've already been a successful founder.
Yep. If you're a serial entrepreneur, you're going to have much easier time. If you go to Harvard or Stanford, you may have an easier time. There's a lot of hacks. Unfortunately, they may not be fair necessarily, but really it's a signal game, right? Because you're ultimately betting on the future, and so you're trying to take information or whatever gut feeling you have and use that to underwrite. But the more competitive the market is, the more people are chasing a deal, the more likely people will start, flexing on their criteria just to want to work with you.
Right. And so somebody who's
FOMO.
listening, yeah, FOMO. And FOMO is so real in every aspect of life. It's hilarious. Even like celebrities, right? Like I think George Clooney like sold his brand Casamigos for like 600 million or something.
Yep.
And then all the celebrities, The Rock, Ryan Reynolds, all of them start, Conor McGregor, they all launch an alcohol brand, right?
Yep.
So you get FOMO at every stage and level of wealth, which is funny. So if someone's listening to this, right, and they have an idea for a business, and they know that the idea is really good, how do they actually get the attention of an investor like yourself?
Mm-hmm. It's a good question. I mean, the best thing to do is to go to people close to you and try to raise money, like friends and family, if you can, to try to prove traction. Because the more traction you have, all things equal, the better terms you'll get. Outside of that, the best thing you can do to get in front of VCs is just to literally, hopefully first, get someone you know to introduce you. If you don't have a connection, then the best thing to do is cold email them, or actually cold contact them. They're probably more accessible on Twitter or LinkedIn than they are via email. But I think it's hustle. And one thing you can do to kind of hack it is to create connections with people that have raised money before. And so if you find founders who have started companies, raise money, they're going to know the VCs well. They can lend you credibility. They potentially may invest in you. And they also can show you the ropes so you know how to navigate the process a little bit easier. I think how you talk about things, the jargon you use, can influence how successful you are and how quickly your process is.
I love it. So the last question that we ask everybody on the podcast, and this is a fan favorite, is if you had a time machine, but you only had enough time to go back in time and talk to the 18-year-old Jarrid, but you only had enough time to tell him one thing about success, happiness, fulfillment, life in general, what would you say?
I would tell him to take a just-in-case approach to relationships instead of a just-in-time. What this means is, like, don't just talk to somebody when you need them, right? And be transactional. It's like gradually over time, meeting people, creating a good impression, telling them what you're interested in. And then you have this whole Rolodex of people that hopefully are supportive of you. And so when you do go to do something, they'll be in your corner. I did not do that. It's something I started doing recently. My business partner fortunately did that, and that's why we're able to get launched. And now we all have that same mindset.
I love it. So if people want to learn more about you or Harlem Capital, or they want to reach out or try to get into your fund, what's the best way to do that?
Best way is to go to our Twitter, at Harlem Capital, one word. Alternatively, you can go to our website, harlem.capital, have a ton of good resources there. And from there, you can find all of our social media handles.
Awesome. Well, thanks for coming on, Jarrid. You're a cool guy.